we would be already bullish on the week. We would anticipate this movement from the open and down. We would not be interested in anything from the open to trade up first. We would look at that as not interesting. We would wait for it to drop down into an oversold condition. What makes it oversold? Because its opening price is value. Okay, that's fair value at the time of new trading. At some point in the future, we would anticipate the market dropping down. Okay, that drop down from the opening price is going to make price in terms of overbought, oversold, because the context or premise behind it, we would already be bullish relative to the monthly and weekly chart. So if we're expecting the weekly chart to continue higher, the new week, we would expect to see the opening price, the drop down, which is a Judas swing. This engineered move is to knock individuals that are already out long, or drive individuals that are not in the marketplace that want to sell short to entice them to do so. Any pending orders that would sell in a breakout, they would be filled down on this movement here. So you as a short-term trader, you could elect to buy at one of these levels below the opening price that my tutorials teach some of, but we go into great detail with that in the mentorship. So you can frame all types of entry techniques and concepts. They reside below the opening price. Okay. The way we use this information from the free tutorial standpoint is if we know that the low of the week from the opening price on Sunday, making the low of the week on this weekly range, it's going to form between Sunday's opening and Wednesday's New York open. The odds favor a greater chance of the low forming when you're bullish between the London setup and the New York setup of Wednesday. So Tuesday's London setup to Wednesday's New York setup. Between those two time periods, I'm going to encourage you to go through your charts. It's really, really easy to go through hindsight data, and you'll see what I just told you is like the elephant in the room. Is most traders, they don't know what to do with it below the opening price when we're bullish. So which level do you buy? In this instance, I'm just going to teach the classic market structure, bullish optimal trade entry. Okay, so you're going to anticipate Tuesday to Wednesday's low forming. Now, sometimes it's going to form on Monday, but you can still get a continuation move on Tuesday or Wednesday. But primarily, I want you to be thinking how Tuesday to Wednesday in that time period, that's when the weekly low is going to form. Many times, it's going to be Tuesday's London open. Okay. Now, if that's going over your head, I want you to stop and think about what I just told you. The weekly low most likely forms on Tuesday's London open when we're bullish. If we are bullish and it does not form on Tuesday and we drop down on Wednesday, Wednesday will probably be the low of the week. If we go lower than the low formed on Wednesday's New York open, you have to nix the trade and go to the sidelines on the day, especially if you took an opportunity on Tuesday or Wednesday and they were losing trades. You have to stop and just submit to the fact that you were wrong, even if Thursday or Friday it goes higher. And that's a very hard lesson to learn because you are bullish on the week, but you get stopped out and it still ends up going there and you missed out on it. That's going to happen. It's happened to me many, many times, and it does not undo the effectiveness or the validity behind the setup. There's going to be an imperfection in your trading, so you have to permit that, okay? But if we're looking for the low to form on Tuesday or Wednesday, what we're simply looking for is a new low in the week, preferably on Tuesday's London open or Wednesday's New York open, okay, between those two reference points. Should that occur, okay, as soon as we have a lower low in the week formed, we find the short-term high prior to that new low forming. In this case, it's this here, okay? So when that occurs, that's our trigger point. So for individuals that want to buy on retracements with optimal trade entry, we're going to wait for price to break above this short-term high, which it does here. From this point here, you're going to be looking for the low to form prior to this run-up. Now, classic fib people will go from this low to this high. Sometimes that'll work. Sometimes it won't. What I want you to look at is we have the most dynamic price movement off of this low. So you're going to anchor your fib on the lowest close or open in that swing low. Drag it all the way up to this body here. Now, use a 30-minute chart, and you'll be able to see pulling that fib from that low to this high. You get an optimal trade entry beautifully lined up right there. And there's your continuation buy. And here's the thing. You're buying it below the weekly open on Sunday. You're buying below that weekly open, trying to do power 3 on the week. This gives us the best advantage, okay, to be in before the expansion that takes place on the weekly range, because we're buying below a valuation that would deemed as fair, and then it drops down to an oversold condition. So while everyone else would look at these movements dropping down here and dropping down here as momentum on the downside, our perspective is like of the smart money. We're looking at that as it going down to an area of a really, really cheap price. So if you're terribly afraid to step in there right when it breaks below to a new low, I understand that, but over time you're going to have to encounter that and just move past it, or just elect to go with optimal trade entry as your pattern. And there's certainly nothing wrong with it. But if you're wanting to buy up here and you're always going to wrestle with the idea, I wish I would have bought down there, this is only going to occur if you buy at new lows at a time when it should be creating the low of the week. So this would be the optimal trade entry here. And again, it's on a day that we would look for it to form on Wednesday. And price starts to expand. We get about above the opening price. Preferably, we want to see price show a willingness to want to expand away from that opening price and not want to come back down to it. Now, there are some certain caveats to this, and I'll add this to you just to give you a little bit more spice on this. If we make the low of the week on Monday, how do we know that? It trades back above the opening price, okay, on Monday, and expands a little bit more, okay? This right here, we dropped down and went back above the opening price. I don't trust this because it's Monday, and I like to see the Monday's range. Okay, I want to see what the Monday's entire daily range is. So I don't get the weekly lows many times. Actually, let's just be fair about it. About 98% of the time, if the week makes its low on Monday, I'm missing that because I elect to sit many times on the sidelines because I want to use the range of Monday to give me insights. So on Tuesday, I like to get hopefully a lower low when I'm bullish, and then I'll buy in there, okay, based on some pattern or some kind of a key level I teach. And then I'll ride that out and hopefully get back above the opening price. Now, if we trade above the opening price on, say, Tuesday, I will permit Wednesday to see retracement back down to the opening price, find some support, and then rally back away. On Wednesday, if we're breaking above the opening price on Wednesday, it cannot and it should not come back to opening price. Now, again, in simple terms, Wednesday is the line in the sand. If it trades above the opening price when we're bullish, we do not permit it to come back down to the opening price. It can happen if we go above the opening price on a new low on Tuesday. We could still see it come back down and retest that opening price on Wednesday. The algorithm will want to expand away from this opening price after Wednesday because it only has New York opens time period to Friday's close. And that's why you see this acceleration in the movement on the weekly range immediately after Wednesday breaks above the opening price. Okay, so once we get through the opening price on Wednesday or on Tuesday or Monday, I personally will never get the low on Monday of the weekly low. I won't get that on Monday. You can try to test that theory and buy down here, and you might get something like this, and this could have kept on going. If you're going to trade on Monday, if it trades back to the opening price, my opinion is to take some profits there and leave a stop in, so that way if it does knock you out, it protects any open profits, but leave it in there because you might have caught the tiger by the tail. Statistically studying all the possible scenarios and weekly profiles that I teach, I elected to simply wait till Tuesday. And that's just the way I do it. Tuesday, I'm really actively looking at London Open. Okay, that's really what I'm looking for. So between London Open on Tuesday and Sunday's opening, I'm really not doing much at all. I'm just relaxing and spending family time. I'll glance at the charts, but I'm not really trying to actively pursue anything until around London Open on Tuesday. And if you look at the weekly ranges on the foreign currency pairs, you'll see that many times when we are indeed bullish or bearish, these turning points will form on Tuesday's London Open. But for this example here, we're bullish, and we're looking at the opening price on Sunday. We want to see it drop down. It trades down to a level. We wait for it to break a swing high. Okay, and this could have easily formed on Monday. And the retracement could have been occurring on Tuesday, like it is here on Wednesday. And then Tuesday could have traded through the opening price. And we could still permit it to come back down to that Wednesday retest of the weekly open. But after that, it's not allowed to do it again. If it ever starts to gravitate back down to that opening price after Wednesday, trading through it, it's probably made a reversal or it's going to consolidate for the rest of the week. Either one's not good for a weekly expansion. Now, there's going to be times where we'll trade above the opening price on the weekly range and not go very far and just gravitate right back to the opening price. And it's going to be a quiet, mixed week. If it's still bullish the following week, we would still use the same criteria. Okay. But the next stage would be we would be expecting that expansion here. Now, this portion of the weekly range is going to be what you're holding for, and eventually until Friday's close. Your mindset should be not trying to find 10 pips or give me 20 pips, okay? I start my week off looking for scenarios that get me in down below the opening price because I understand that below that opening price is the ideal entry point for all my day trades and my short-term trading. As a short-term to swing trader, you can use that insight using the weekly ranges and not require yourself to be anywhere near an hourly or 4-hour chart or anything less than that. The weekly smart money view for bearish conditions. Okay, you can see here we have the same thing just reversed. We're looking for the weekly high to form between Sunday and Wednesday. High odds between Wednesday's New York Open, 7 a.m. from Sunday's opening. That's what we're looking for. But the odds further increase again between Tuesday's and Wednesday's trading, specifically focusing on Tuesday's London Open to Wednesday's New York Open. Okay, so we're looking at the weekly range here for this particular currency. This happens to be the dollar CAD. And you can see how price did in fact have a up movement on Monday, and then we had another movement up on Tuesday, creating the high of the week during the London session, or what we were looking for the scenario overall. We anticipate a bearish week ahead of the open. Once that opening price is derived on Sunday, we extend that through the entire week until Friday's close. Movements above the opening price, we anticipate that. We want to see price go to a level that would push price into a technically overbought condition. The fact that we're trading above the opening price in a market environment that's bearish longer term, that's what frames my idea of overbought. High of the week forms on Tuesday. Wednesday, we barely have any type of movement whatsoever. We still have a little blip on the radar as price runs it back above that opening price and then quickly rejects. Notice that once it leaves that opening price on Wednesday, it doesn't try to go back to it. Now, it does retrace here, but it's not getting close to it. If it does, it's going to be a mixed week. We don't want to be a part of that, okay? And ultimately, price comes down, fails at this old low, and then we see a reversal. That's outside the scope or the focus. The point we're looking for is we want to be, when we're bearish, we're looking to sell short on or at very close to the weekly high and riding that down to some measure of expansion below the weekly opening price. So in terms of the weekly range or weekly candle, what we're looking at is the opening price here. Then we're seeing the Judas swing. This is the portion of price action that we're anticipating. We anticipate this type of price action, and we want to have a level in mind before it starts to even trade up where we're wanting to sell short. In this example, a real good example would be we have a high here and a Monday's high. So we have relatively equal highs. Price stabs above this, you could be a seller here. And I did, in fact, take this trade, and I shared it on Twitter. You guys can see that. Go through my Twitter feed, look at the date for around November 21st, 22nd. I would have shown the example, and my entry points and everything's in there. Sell short with the expectation that there's going to be a sell-off on the dollar CAD. Price sells off, goes below the opening price. Now, remember what I said. As long as it is before Wednesday's New York Open, it's permissible to see price trade back to, in this case above, the opening price, because on Wednesday, that's when it should leave the gate. Once it starts leaving that opening price, it's going to expand to reach for some measure of price action that creates the movement below the opening price. So the range expansion portion of the weekly range, that's what you're holding for, but you want to be positioned up here while price is going up. When it's long-term bearish, it feels scary. It feels odd. It feels out of place because you're watching price shoot up like this, and every retail-minded trader out there and every person that's on Twitter and Facebook, they're going to be looking at this thing saying it's going to the moon, and it's not. It's a southbound train. Once this thing leaves the station, which is the opening price on Wednesday's New York Open, draw that line on your chart. Once that occurs, it should always try to expand away from the opening price. You should have a predetermined level where you're going to be getting out at inside of this expansion. Okay. In this case, we have relatively equal lows here. We have a low here. We have a low here. And that gets us to this price point here. It goes a little bit lower, but then ultimately comes back with a deep retracement and then closes into the week, giving us the weekly candle or range profile like this. The ideal scenario is to look for a sell above that opening price. As a day trader, you could be focusing in on that, and or as a short-term trader or swing trader, you can use the weekly candle or weekly range to trade entirely off of that and not even look at an intraday chart, not even a daily chart. You can take these types of trades and again, look for that same scenario. Wait for it to trade about 30 pips above the opening price. Okay, in this case here, we opened around here. We can go up 10, 20, 30 pips. So you could be a seller around 2805 and a stop loss of 150 points or pips. Okay, and then try to get 150 to 300 pips profit from that. By selling at 128.05 or thereabouts, price goes all the way down to a low of approximately 26.75. I gave you this example to see and show you how even using the objective of 150 pips to 300 pips, you may not get that actually in your profit, which is why I teach to take partial profits. So if we sold short hypothetically at 128.05 or whatever, 30 pips would be above that opening price. If we sold there with the expectation that we're going to try to capture 150 pips or more, as soon as you made 100 pips, why wouldn't you want to bank there, seeing that we're probably only going to make about 130 pips on this move? 100 pip movement, anytime your moves ever trade at 100 pip intervals, you have to take something off. Learn to do that. If you do not do that, I promise you, you will look back and regret not having done so. So as a day trader, obviously if it moves 100 pips, you certainly want to be banking 80% of your position. And if you're a short-term trader, you want to be at least half your position out, because the weekly can change gears midweek. For instance, it could have went down to this low here and then traded all the way back up and taken out the Tuesday high. Those occurrences can happen. So if it's offered up 100 pips, take something off at 100 pips, regardless of what style or what type of interval of trader you are. If it gives you 100 pips, pay yourself on those 100 pips. Even if it's 1/10 of your position overall, do it, because number one, it'll feel good to do so. It'll pay you for your time and the risk that you put in. How many times have your trades gone to full profit? How many times have you failed to take something off if you just would have taken something before it turned back on you? That's what I've been doing for 25 years, folks. Okay, 25 years. I've seen enough of this to know partial pays. Okay, it pays. You have to give yourself the ability to take something out, because the market is not going to do it for you. You have to take it out. So if you're going to be a short-term or swing trader, and you want to use the weekly range like this, if we expand 100 pips, we're looking for 150 to 300 pips for the week. You're not always going to get 300 pips. But preferably, if we're bearish in this case, we want to see hopefully a big weekly range. Remember that small range, big range phenomenon? Well, if we're starting to see small weekly ranges right ahead of this, and we're still bearish, if we get this scenario here, we can do very, very well. You can see those big 300, sometimes even 500 pip ranges on a weekly, especially if there's going to be a lot of news, a lot of things that are happening, economic calendar. It can be extremely volatile, and it creates a large range on the weekly. So the model is we look for, if you're a short-term swing trader that can't be in the intraday stuff, you can sell short above the opening price about 30 pips. Now, again, with the expectation that you're not always going to get 300 pips, but if it allows you to make 100 pips when you take your first partial off and then put your stop at break even, you're in a beautiful position. Because if you take, say, half your position off at 100 pips, put your stop at break even, and then see if it gives you any more movement for the rest of the week. Now, if you are able to look at the market Tuesday or Wednesday, and you only have to do it on those days, around Tuesdays, London Open, and Wednesday's London Open, if you watch those specific time points, you can look at specific levels in price action that I teach in my tutorials and go into great detail with the mentorship. You can sell at a more favorable entry point. And you won't have to just say, okay, well, here's the opening price on Sunday. I'm going to take a set number of pips above the opening price all the time and sell short there when I'm bearish. You can avoid that, okay? And you can say, okay, well, at the opening here, okay, I'm going to watch and see what Monday does. Monday's dilly-dallying around, creates a Monday high here, and we start trading here. We start to drop down ahead of London. We're not interested in that. We're looking for this high and this high here, double tops. Okay, what's going to be resting above that? Buy stops. So if you know that, going ahead of Tuesday's London Open, you could just simply do a sell limit order right above the high on Friday or a high on Monday. And then you can really reduce the amount of exposure you have and then still have that same 150 pip profit objective.